Hey, what's up everyone? Welcome back to the channel. If you've ever wondered what the heck an IUL is, or whether you should invest in mutual funds or something a little fancier, then you're in for a treat today. Because in this video, we're going to break it down. Mutual funds versus IULs, what's the difference and which one should you choose for your investment strategy? And I know, financial topics can sometimes feel like that one cousin at family gatherings, a little complicated, a little boring, but super important to understand. But don't worry, I'm going to keep things light, fun, and of course, informative. If you get value from today's video, make sure to hit like, subscribe, and don't forget to share this video with anyone who's been wondering the same thing. Let's get started. Okay, let's start with the classic, mutual funds. So, what are they? In simple terms, a mutual fund is a pooled investment where a bunch of people throw their money into a big pool, and that pool gets managed by a professional fund manager who makes the decisions on what stocks, bonds, and other investments to buy. Imagine you and your friends decide to buy a giant pizza. You're each chipping in a little bit, but you're letting the pizza chef, aka the fund manager, decide whether to go for pepperoni, veggie, or supreme. You all get a slice, but you don't really get to decide the toppings. That's the fund manager's job. Mutual funds are great for beginners because they offer instant diversification, which is the fancy way of saying your money is spread out among many different investments. Instead of putting all your eggs in one basket, like just buying a bunch of Apple stock, a mutual fund can buy shares in a variety of companies or assets. And if you're like, okay, but what's the catch? Well, mutual funds do have some fees attached. Fund managers charge a management fee for their services. And while these fees are usually pretty reasonable, they can eat into your returns over time, so be sure to keep that in mind. But here's the upside. Professional management, you're basically paying someone else to make investment decisions for you. So you don't have to worry about tracking the market all day. Plus, mutual funds make it easy to invest in a bunch of different things with just one purchase, so it's a pretty hands-off investment. All right, now let's talk about the other side of the coin. IULs, or Indexed Universal Life Insurance Policies. Sounds fancy, right? I promise, it's simpler than it sounds. An IUL is a type of life insurance policy that combines a death benefit with an investment component. Now, don't start rolling your eyes thinking this is just about death benefits and boring insurance stuff. This is where it gets interesting, the investment part. You're investing your money into an index-based fund, meaning your returns are tied to the performance of a stock market index like the S&P 500. So, let's say the market goes up by 10%. The amount your policy earns is tied to that performance, but, and here's the cool part, you're protected from market losses. So if the market crashes, you don't lose your money, you just don't earn anything that year. No down years. An IUL allows you to accumulate cash value over time, which you can later borrow against or use as collateral for loans. But key point, it's not exactly like investing in stocks. It's more like a hybrid between insurance and investing, with some tax advantages as well. You can grow your cash value on a tax-deferred basis, and if you borrow from it, the loans can often be tax-free. Now, before you get too excited about using your IUL as a tax-free money-making machine, there are some limits. The returns tend to be capped. So, if the market does crazy well, you might only get a portion of that upside, but at least your money is safe during those wild market drops. It's like a safety net, a comfy financial cushion. IULs are also a great option for people looking for insurance coverage combined with some investment potential. But if you're just looking to grow wealth aggressively, this might not be your best bet. More like the slow and steady route. So, let's talk about the big differences between mutual funds and IULs. It's like comparing apples to oranges, but both are healthy for you, just in different ways. Investment type, mutual funds. Your money is invested directly in a variety of assets like stocks, bonds, or ETFs. You're taking on the market risk, but you have the potential for higher returns. IULs. Your money is tied to a stock market index, but you have a safety net. You won't lose money in a market downturn. It's lower risk, but your returns are also capped. So, with mutual funds, it's like going to a roller coaster park. You get the thrill, but sometimes it's a wild ride. With IULs, it's more like a bouncy castle. Safe and fun, but you won't get the crazy height or speed. Purpose: mutual funds, mainly used for wealth accumulation and growth over time. You're building your portfolio for things like retirement or long-term financial goals. IULs, designed for insurance protection with an investment element. It's like a combination of a safety net and an investment vehicle. It's a more long-term plan that includes a death benefit. If you're just thinking about growing wealth, mutual funds are probably your go-to. But if you want life insurance protection and want to grow some cash value over time, IULs might be a good fit. Just keep in mind that the returns might not be as flashy. Liquidity mutual funds. You can access your money whenever you want. Liquid as a fountain. Just sell your shares and bam, you've got cash. ULs. Accessing your cash value is a little trickier. You can borrow against it, but it's not as liquid as mutual funds, and there could be fees and penalties involved depending on how and when you access it. Mutual funds are like that emergency fund you can dip into whenever, while IULs are like that secret savings account you can only access with a little more planning and paperwork. So it's kind of like the difference between reaching for a candy bar in your pocket versus having to go dig around for a treasure chest key. So, now that we've broken it down, you might be wondering, which one is better? Should you go with mutual funds or should you consider an IUL? Well, it really comes down to your financial goals. If your goal is to build wealth aggressively, especially for retirement, mutual funds are probably your best bet. They give you the flexibility and potential for growth, and you can always adjust your strategy as you go. But if you're someone who's looking for insurance protection along with an investment option, and you're okay with the trade-off of capped returns for some market protection, then an IUL might be a solid option. Just keep in mind the fees, and make sure to work with an advisor to understand how it fits into your overall plan. All right, folks, that wraps up the mutual funds versus IULs debate. I hope this video cleared up some of your questions. If you found this helpful, smash that like button, subscribe, and definitely share it with anyone who might be on the fence about these options. We want to spread that financial knowledge, right? And if you have any questions or if you're still trying to figure out which one's right for you, drop a comment below. I'm always here to help you make sense of the financial world. Until next time, take control of your finances, make smart decisions, and keep crushing it.